And this is the kind of bifurcation you guys are going to have to carry with you outside the classroom and use it going forward in your practice for the next 20, 30, 40, 50, 60 years, right guys? Good. Chapter 3, transactional planning and advice, client conflicts. Okay? I will say this now, I will say it again, so I apologize for my repetition, but what is the number one reason, and you'll hear this, and I'm telling you, I'm not going to plant this. I think he'll say it. Remember, we have one more guest speaker in 2 weeks. Tim Saya is going to talk about accounting malpractice. What is the number one reason why accountants get sued? What brings on the lawsuit, guys?
The IRS?
Not the IRS,
Well,
because
the
remember.
IRS doing something fine.
Well, that goes without saying. But what is the number one cause of malpractice? So, what do you think? Penalties, but penalties is one. I mean, people are going to sue you if they get hit with a penalty. But the number one reason, Tim will say, is client conflicts, okay? That conflicts with your clients, that you took on clients that had conflicting interests, and the perception is you favored the other person. And that being the case, you shortchanged your client. They thought you were going to give them a good deal or represent them, and meanwhile, you're representing someone they no longer get along with, right? So, client conflicts, or probably the number one cause for people, accountants getting sued. So just be forewarned as we're going through this, and you might say, gee, I would always know when someone's being sued or when there's a claim. Sometimes it's surprising. And let me just emphasize, and I've seen this all too often. I'm not going to tell you the whole story, but I represented a father, and he always had his two sons, and he was divorced, and he didn't get along with his daughter, okay? She was nowhere to be seen, and his will was leaving it to the sons, and all this other stuff, okay? Long story short, what do you think happens 5 years later?
The daughter shows up.
Yeah.
Well, the daughter shows up with him at my office because he no longer gets along with his sons, he only gets along with his daughter, okay? So, people, I hate to say it, there is a lot of dysfunctional families. Is that a fair statement, guys, out there? And you may feel you're part of one, okay? That's okay. I mean, but there are a lot of dysfunctional families, okay? And just be very careful, and you don't know who's dysfunctional and who not. But families are really weird dynamics, right? And the fact that
changing that's good for business.
I'm sorry?
If they're constantly changing these wills and plans, that's
It
good
may
for
be
business.
good, but you've got to be careful who's there. And I've gotten, as I've gotten a little bit older, a little bit, I think, on some days, a little bit wiser, that I'm like really try to be attuned, because in yesteryear, it's very hard to say no to business, right? Because we're all trained to say yes, because we work so hard to get the business. And then it's very hard to say, no, I can't represent you, or I shouldn't represent you, or not to represent you, because it's not within our DNA. I'm telling you. So the hardest thing you can do is to say no. And it's the best thing you can do when the circumstances cry out. And just try to be very, very aware of that, guys. If I can save you from one lawsuit during your career, your time here was like worth it tenfold. Having been sued myself, the anguish is not worth it. So just be careful. You will never think that fee that you earned was a worthwhile fee. I can assure you of that. All right. So let's talk about client conflicts. The author has described that the model rules applicable to attorneys have certain rules to prohibit. You're not supposed to engage in representation which is going to impair your interest where there's a conflict. On page 100, the authors talk about Appendix H. Okay, so if you want to turn to Appendix H. Appendix H is AICPA Code of Professional Conduct, and it deals with conflicts of interest. I think B took a helicopter here because she just saw a pretty woman.
I did.
How did you manage to get from New York City
I
here?
drive like a man.
I wouldn't even go there to interpret that, but I think everyone in this room gets the gist.
You are being recorded.
Yeah, thank you for that. All right. So, in terms of Appendix H, and that may be our guest speaker, who I said, it would be a good idea, he didn't come at 6, but I think this will be our guest speaker. Hold on, let's see. Up. Are you here? Okay, come up to the second floor. We're looking for you. We're anxious to have you here. Yeah, come on up to the second floor. You'll see there's a restroom, and then we'll be waiting for you. All right. See you soon. All right. So he's going to be here, and I will give him the podium because I don't want to keep him waiting. He doesn't need to hear me. But Appendix H describes conflicts of interest, and you will see by Appendix H, if I can keep my finger there. Okay. We'll describe, and I think these are kind of nice examples, and you could fill pages, not just one page. If you look at page 424, talks about, page 424, talks about all different kinds of conflicts of interest, including, the easiest ones are like letter L and M, providing tax or personal financial planning services for several members of a family whom the member knows to have opposing interests, referring a personal financial planning or tax client to an insurance broker or other service provider, which refers clients to the member under an exclusive arrangement. So you're doing it under an exclusive arrangement so that the client may not get the best. You're not really looking out for the client, you're looking out for your own monetary interest. That's inherently problematic. But if you go through this, you'll see all these are conflicts of interest. If you look on page 425, evaluation of a conflict of interest. When an actual conflict of interest has been identified, the members should evaluate the significance of the threat created by the conflict to determine if the threat is at an acceptable level. Members should consider both qualitative and quantitative factors when evaluating the significance, going on from there. And ultimately, one of the major things you can do, sometimes it works, sometimes it doesn't, you have to be careful, is you're supposed to disclose, right? You're supposed to disclose, and when in doubt, guys, disclose, okay? When in doubt, if there's any doubt in your mind where you think there's even a sliver of a chance that there may be a conflict of interest, then you should disclose, right?
To the client.
To the clients, plural, because it's conflict between and among the clients. So, what harm can come? In other words, once you make disclosure, assuming they understand and they say, no, we want you to keep doing the tax returns for the company and for the shareholders. Can they subsequently complain? If you put in writing that there's potential conflict and they, in writing, say, we understand that there's a potential conflict, we nevertheless want you to represent all the foregoing parties, that's gonna clear you. But don't do it verbally, because everyone forgets. This is Bob Stern.
Hello.
Bob is one of the foremost
Already it's a lie.
foremost tax/criminal attorneys in the state of New Jersey. He's represented publicly, so I don't say the wrong things. Like some of the people that you may know, they may know. Is it fair to say you and Rich both represented the situation? Well, unfortunately, he's just going to jail today.
Yeah, it had nothing to do with us though.
Okay, and several other people, including, I think,
It's been a lot.
there's a lot of them. What's the name?
Yeah, I-
New Jersey Housewives, right?
I'll give you a statistic, just so you know. The IRS Criminal Investigation Unit for the entire country investigates about 3,000 to 4,000 cases a year. Most of those, if not the far majority of them, plead, because by the time the funnel gets it to the U.S. Attorney's Office, there's actually an indictment and a subsequent prosecution. It's a paper crime for the most part. It's very easy to prove. So what happens is that 98% of those cases that get to the U.S. Attorney through the system plead. And at the other 2% that go to trial, 95% lose. So if you get picked up by IRS criminal investigation, there's a good chance you're gonna go to jail.
So it's not a good day for you. So let me turn over the podium. Let me just give you a lay of the land. We began class at 5, around 7 o'clock. We usually take a break, and there's some pizza coming, so you're more than welcome to have a slice. And we'll take a few minute break, and you'll keep going because I know your time is valuable. So I'm going to get out of the way, and Bob can answer any and all your questions regarding criminal tax issues and the like. You should keep his name handy, not for yourselves, but if any of your clients ever have a criminal tax issue, you should have him on speed dial.
Okay, so
I'll sit back here.
First of all, I can't stand up and lecture for 2 hours, so I need help. Okay, and I promise this is not going to be one of those, go to the Internal Revenue Code section 1.62, because I always hated that when I was in graduate school. So I'm not doing it. Well, what I'm going to do is I'm going to tell you a little bit about myself, so you know the perspective that I take in my partner Rich Sapinski case. When I got out of law school, I did a 5-year stint as an IRS litigator. So if any of your parents, I know you guys are too young, but if any of your parents met me as an IRS litigator, that wasn't a good thing. Okay? I left the government and I got into private practice, and I've been doing this for a very long time right now. But I love to tell IRS stories because some of the things that I've come across in my years are just hilariously funny, and they're things you just could not believe. So when I do Bar Association lectures or I do CPA groups, I generally sprinkle in a few stories for the laughs. Do I have IRS people here? Where are my IRS people? Right? No one's admitting? I had a professor at NYU, he'd always say, when I was in the graduate school program there for an LLM, he'd always say, where are my IRS people? Because the IRS people are the ones who know the inside scoop of what's going on currently there. Do I have CPAs in the group? Is that what I got, Professor?
Yes.
Who are my CPAs? Practicing CPAs? You guys working for firms? Okay, and that's fine. And the rest of you, I guess, trying to be CPAs? Is that that's basically the story? Let me start with the thing that was most current. Everyone saw the billboards out on the highway with New Jersey amnesty, tax amnesty ended yesterday. Actually, I'm sorry? You filed many. They actually kept the regional offices open until 12 o'clock yesterday. Midnight, they had staff with them. And it'll be very interesting when the figures come out as to how much money they actually took in. This is the 4th New Jersey amnesty, and each amnesty, it's not just Jersey, it's all states. Each amnesty, they tell you, this is the last amnesty. But of course, as each new administration comes in, all the governors want to spend on their own programs because they like to get reelected. And there's always another amnesty. And there have been amnesties all over the country. I've dealt with them in Pennsylvania, Connecticut, New York. I mean, they are all over the place. California had them for a very long time. This was one of the most, if not the most attractive amnesty that was given. And do you know why?
Reduced a lot of.
They reduced. Almost all of the amnesties that have come out in the last 20 years have been when you pay the tax and you pay the full interest. New Jersey put a sweetener in there, they kicked out half the interest. That's pretty darn good, especially for a lot of the clients we saw. We had clients with multi-hundreds of thousands of dollars in debt. And when you ran the amnesty for 7 or 8 years during the amnesty period, and you kicked out half the interest, it was a significant savings. So I think New Jersey's gonna do very well by this.
So the key is to wait for the next administration to make a payment.
If you don't get prosecuted first, I think. Actually, it is a felony in New Jersey not to pay taxes. You didn't even know that? It's a third-degree felony, I think, here in New Jersey. Of course, you gotta show intent, of course. Also in New Jersey, very interesting. You know New Jersey has 100, if you go on the website, they have a deadbeat list. Did you know that? You can actually look up. There's a website, Jersey publishes the list of the 100 biggest debtors individually and the 100 biggest debtors for businesses. So if you go, I can't sit all day, a lot of times. And I need help. You're gonna have to help because I can't speak for 2 hours. But they actually do publish that list. So if you go on the website, you're gonna get a list of people and businesses with the amounts of money that have been assessed against the individuals. I actually have a few of those over the years. I've had a few of those people on that list. There was a period of time where they sent prosecution letters to people on that list. Okay, they actually threatened to prosecute. I mean, the word threaten is not a good letter, but they sent a letter out suggesting if you don't pay, there could be a prosecution in your future. So that actually brought a lot of people in. Because the threat of prosecution always does. So, that was New Jersey amnesty. So it ended yesterday, and then, of course, once amnesty ends, they're gonna ship it on off to Pioneer Collection, which is their private debt collector out here. They're gonna put an 11% collection fee in. They're also putting a 5% amnesty boost on it. For those who didn't come in, they call it a 5% amnesty penalty.
Part of the recovery.
Well, whatever they wanna call it, they can call it, but it's a 5%, it's actually a 5% amnesty boost for not coming in. And the 11% is a recovery fee.
The IRS hired Pioneer now as well.
Yeah, I'm gonna get to that in a few, I'm gonna get to that in a little while. Actually, Pioneer is now a secured part of the IRS private debt. Actually, I'll do it right now. The IRS twice, 3 times actually, the mid-90s, the mid-2000s went to private debt collectors. Interesting enough, they went to private debt collectors. And the first 2 times they tried it, actually lost money, so it got criticized. They were losing money on all these cases they shipped out. So they've gone now to a 3rd time to a private debt collector. They've hired 4 private firms around the country, Pioneer being one of them, who does New Jersey here, as this gentleman suggested. And they're out collecting. The program is fairly new. And I'm gonna cover it in a little while with a bunch of the IRS programs that came out. Passport revocation, everyone know about that. You have clients who've had their passport revoked, or got the letter that a revocation is in the air. And also the way New York tried to do it with a driver's license revocation. So I'm gonna cover that in a little while, but the hot topic in New Jersey right now, and has been for the past 10 years, has been, anyone know? Anyone know what the hot topic is with the IRS right now? Overseas accounts, international accounts in Switzerland. That's been going on for about 10 years right now. I'm gonna give you a little bit of history of the program, and I'm gonna tell you what just happened, and a very, very important case that's being litigated here in the 3rd Circuit, which all the practitioners who practice in this area have been following very closely. So, here's the history of this, okay? This is kind of a 2-credit course that teaches in NYU in the LLM program. It's 24 hours. I'm gonna give this to you in about an hour and a half. Anyone take the tax procedure course here? Anyone taking it?
one case.
Were you there when I lectured? I lectured last year at the Texas.
I think you were.
Okay, I hope you didn't boo me, but, so anyway, this is actually a 24-hour course. I'm gonna cover it, and you should get good insight into how the IRS operates and how outside practitioners operate. This is what happened. Back when I was an IRS lawyer litigating for the IRS, we all know, as did the general public, it was not a secret, that people hid their money overseas to avoid U.S. income taxes. You know, you should all know that the U.S. has a worldwide income tax, so that no matter where it earns, you gotta put it on the return. People don't like paying income taxes, so a lot of them, because of Swiss bankruptcy law, started accounts over in Switzerland. And that's been prevalent for many, many years. When I was an IRS lawyer, as I said, we all knew the accounts were there, the money was there. We had no idea how much was there, but we knew it was there. We at the IRS didn't have the tools to get to it. We just didn't have the tools. Under Swiss law at that time, it's since changed. At that time, there was prohibition against revealing these things. It was actually, you couldn't do it. That's how the Swiss hid. We couldn't get to it. But something changed. In 2008 and 2009, this happened. And it's one of the many things that happened that caused the dominoes to fall on the entire worldwide hiding of income. And this is what happened. I asked your professor if he told this story. I tell it because people get hysterical when I tell them this story. There was a U.S. citizen. His name was Bradley Birkenfeld. Anyone hear of him? I'm going to ask you to get your calculators out in a minute, because as CPAs, you guys are going to be good at calculating this. He's an American citizen, very bright guy, falls in love with Switzerland and goes overseas. He's a very well-educated guy. And he works his way up into UBS, which was the chief instigator for these accounts over in Switzerland, into their wealth management fund. Wealth management fund is a euphemism for, we're going to get the American money, we're going to make a fortune off it over here in Switzerland, and it's never going to be reported to the IRS. So they were actually soliciting very wealthy Americans to take their money overseas. And he was in that department. He then says, okay, there's something wrong here. What the banking system is doing by soliciting American customers has to be illegal. He starts writing memos to his superiors. Ignore him. Because why? Because UBS and all these other Swiss concerns are making a small fortune on the money overseas. And I will tell you, having seen a zillion of these over the past 8-9 years, that the only one who made money off of this stuff were the banks. Because they took incredible fees for what they did. Incredible fees. We saw the bank statements as part of the OVDI program, which I'll explain to you in a minute, where the client would make so much in interest, but it was like a smorgasbord of what you paid for. Did you want a coded name? You paid for that. Did you want your mail held in Switzerland? You paid for that. Did you want a secret name? You paid for that. So the banks were making fortunes. So Bradley Birkenfeld, this nice American citizen who loved Switzerland, who worked his way up into a very high prestigious position as a wealth manager in UBS, is writing these memos. And he keeps saying, you're doing something wrong, you're doing something wrong, and they ignore him. So what does he do? He turns around and he approaches the Department of Justice to turn UBS in. That's what he did. And at first the Department of Justice did not entertain him. So he put a whistleblower claim in with the IRS. You know, if you squeal, you get a percentage, up to 30% of what's collected, tax and interest. So he put the whistleblower claim in. And could we shut the doors on possible? So he's going to blow the whistle on UBS. And guess what? Now the Department of Justice and the IRS are interested, because he's going to tell them all he knows. He's going to hand off the names. Okay, that's what he's going to do. The long short of this story is, he turned it over, he became a whistleblower. There was a story behind it, but it's too long to get into. He becomes a whistleblower. Department of Justice turns around and prosecutes him. He came back to the U.S. at Boston Airport. Marshals were waiting for him. They arrested him. Why? Why would you arrest a whistleblower? Anyone have any idea? It's not conducive, right, to having other people turn other people in. But they arrested him. And the reason they arrested him was, if you're going to be a whistleblower, we've done a lot of these cases in the office where people have committed. We've done, the whistleblower claim forms. If you're going to do that, you got to be clean. What he did, Mr. Birkenfeld did, was he held back one of his names. One of his good friends was a multi-billionaire. He held the name back. So the Department of Justice turned around and prosecuted him. And he actually got sentenced to 40 months, even though a senator wrote a letter for him, people were writing letters for him because he turned the Swiss banking system upside down with his revelations. Now, here's the part that might surprise some of you. He sentenced to 40 months. He actually did 30 months incarcerated and I believe 6 months home detention. He got rewarded for blowing the whistle, even though he wound up getting prosecuted and sent to jail. You know how much he got for that? The whistleblower on UBS? He got $104 million. Now, the question always becomes, and I ask this in front of all my CPA groups, so get your calculators out. Would you, as an individual, do 30 months in prison for $104 million? How much is that per month? Someone want to work that number out?
3.5 million.
Per month.
I assume it's probably light security,
Well, do you do it? Would you do it?
Yeah, make that work.
You can make that work. That's one comment. So that's actually a true story.
Is that taxable, event?
It's a taxable event.
So it's still like 60 million, but.
Whistleblower rewards, as far as I know, are taxable events. So,
Do you get taxed on the whistleblower
well,
earnings?
that's a good question. You get taxed? You're my CPA. You get taxed?
It's
You guys
income.
know the answer, don't look at me, you know the
It's
answer.
income, right? Yeah.
Section 61, baby.
It's section 61. But isn't that interesting? So I always get the mixed group. 3.1 million per month?
5.
At a
That's a
million a
lifetime
week.
security. How much is that per hour? I mean, you can work out all the numbers. It's actually, someone worked out the numbers in one of the magazine articles about how much it was per hour. It's phenomenal. So it's like hitting the lottery. So the question was, would you do it? He actually got praised all over the place from a lot of people because even the Swiss recognized that it was uncovering the shield of these Swiss bank accounts. Okay, so that was only one part of the story. When the IRS got UBS, the IRS took a $780 million penalty against UBS for this. UBS actually paid a penalty of $780 million for this, personally with the IRS. And the reason they did it was, you have to remember, if the IRS or the Department of Justice indicts a bank here in the States, if there's a criminal conviction, the bank can't use the U.S. The clearinghouse for banks, and they're essentially out of business because the U.S. dollar is still basically the world currency. So an indictment of a bank kills the bank. And what followed after that was that all these banks got scared. They got scared. And the Department of Justice came out with a program where the banks, all these Swiss banks, there was 100 and something of them, had to self-report themselves. In other words, the Department of Justice said, we're going to prosecute you unless. And the program they offered the banks was, you self-assess. You go through all your records, you tell us who the Americans are, and you come clean. Otherwise, we're penalizing you. So there was this self-assessment going on with all these Swiss banks. And there were literally 100 to 200 of them that came in that way. They hired their own independent CPA firms, the equivalent in Switzerland, and they came into this program to not get indicted. That's essentially what it amounted to. But that wasn't, like the government always does. They got to follow the money. So it wasn't only in Switzerland. Soon enough, the IRS found out that there was a lot of money in India. And they went after HSBC in India. Okay, HSBC in India was in, and they started following the money around the globe. So we had cases come out of the Middle East, South America, I had cases in France, in England, not just Switzerland, tons of cases came out of India, but basically all over the place. Now, when the IRS had the UBS, there was a rumor that there were over 2,000 people, maybe as much as 10,000 people involved in Swiss accounts. And the IRS couldn't prosecute 10,000 people, it just can't be done. So they needed a way, they needed a procedure to get everybody to come in the right way and start declaring the money. And what they came out with was the first machination of the Offshore Voluntary Disclosure Program. So that was the big case in 2008 and 2009. The IRS coming out with the first machination in the program. And they were offering incentives for people to come in, because the IRS, you gotta remember, they have limited resources, so to get thousands and thousands of people to come in, not just from Switzerland, but from all these other countries I mentioned, is difficult for them. So, they offered the first program. The first program basically says, you come in, you're gonna do 6 years of amended returns, you pay tax and interest on the amended returns. You're gonna pay a 20% accuracy penalty on the tax, with interest on the accuracy penalty. You're gonna file FBARs going back, because everyone know what an FBAR form is? You have a foreign, essentially if you have a foreign bank account or some sort of asset that is deemed a financial account overseas, you have a duty, it used to be on June 30th of each year, now it's April 15th, to file an FBAR form. An FBAR form, most of my CPAs, until these programs kicked off, never even heard of them. I had CPAs come in and say, I never even knew the form existed, how could I file it for my client? But, so you had to do the 6 years returns, you had to do the FBARs, and you had to pay a one-time penalty of 20% of the high balance in the account for that 6 year period. So if you had $8 million in 1 year and $4 million in the next, $2 million in the next, you paid a one-time penalty of 20% on the $8 million. Okay? The program ran for a limited amount of time, and the IRS pulled it back. Okay? So there was a gap period, but the IRS was following more money around the globe, more people were coming in, because word was getting out. It was scary for a lot of people. At that time, the Swiss, because they had already collapsed the system, the Swiss were turning names over to the IRS as part of this, and word was starting to get out. So a second program started up. And the second program, they didn't want to reward people for not coming in the first time, so they upped the ante a little bit. Instead of 6 years, it became 8 years of amended returns. Instead of a 20% penalty on the high balance, it became 25% on the high balance. 8 years of FBARs. That was the price people were paying. That program ended. And the service renewed it with a third program, because they were trying to get people into the system. They were trying to get people. There's 7 million Americans working overseas right now. You work overseas, you think you have a bank account in excess of $10,000. They weren't getting anything close to that in FBARs. They were just getting a couple of 100,000 FBARs at that time. 7 million people overseas working. So they came out with a third machination in the program. And again, they didn't want to reward people who didn't come in on the first two programs, so they upped the ante again. And the ante was, instead of, you're going to still do the 8 years of FBARs, you're going to still do the 8 years of tax returns, you're still going to pay the 20% penalty. I'm sorry, you're still going to pay the 20% accuracy penalty, let me say that better. But instead of a 25% penalty on the high balance, we're going to make it 27.5% of the high balance. So the price is going up, and the price you're buying is peak. Because if you went through the program, you had to do steps to get through the program. And if you got through the program, you were guaranteed no prosecution. So that, but it was an expensive way to make peace with the government. That's what it amounted to. It's expensive. Okay? Now we're coming into 2014, and the service is getting heavily criticized. Anyone want to take a guess as to why the service is getting criticized by the AICPA and my guys, the Bar Association, the Taxpayer Advocate's Office? They were being criticized. The reason they were being criticized was because it was heavy-handed. It was like a one-size-fits-all kind of operation. Somebody who genuinely did not know that you were taxed on your worldwide income and you had to file these FBAR forms. Most CPAs, as I said, didn't know. Were getting forced into the program because they were so scared of getting prosecuted. They were paying 27.5% or more, or 20% and 25% on accounts. They were paying big dollars, and they really didn't do anything wrong. So there was a lot of criticism on what happened. A lot of criticism of the IRS. And it wasn't just the Bar Association CPAs. Nina Olson, who's the taxpayer advocate, nationwide taxpayer advocate, they were all criticizing the IRS for the way the program was being administered. So let me give you an example. I had a Holocaust survivor come into me. Nicest old guy you ever want to see. He was perfect for not having to pay that 27.5%. Was so scared. He called me up, he said, Bob, he said, I want to sleep at night. I don't care. I'll pay the money. And I tried to say to him that the program was not, that 27.5 would not apply to him at all. It just wouldn't. He was not that guy. But he was so scared he went in anyway. And he was so scared and I was so worried. I actually wrote him a letter, like a CYA letter, to say that I don't recommend you do it, but you're the client, you want to do it, be my guest, but really you shouldn't. But he went in. So in July 1, 2014, because of the heavy criticism the service got, they rolled out a version. They rolled out a version of the program. And what they did was they broke it into pathways. So for people who really did nothing wrong, because I can tell you how many people I saw that said, you're going to take 27.5% of what I got. And you remember what happened was you're going back 8 years. So in 2009, what happened? The market crashed. So a $5 million account could be worth $2 million. You're paying 27.5% on the $5 million, not on the $2 million. So a lot of wealth was getting wiped out. So the service came up with this program called the Streamline. And it was meant to be just that. It was meant to be a very quick process to get through the system. And instead of doing 8 years of tax returns with the penalties and the FBARs and the 27.5%, the Streamline said, look, you know what you did. We're not betting against ourselves. This is the IRS speaking. We're not betting against ourselves. You know what you did. And if you really did nothing wrong, what you're going to do is you're going to tell us 6 years of FBARs, you're going to do 3 years of amended returns, and you're going to pay a 5% penalty, not on the high balance in a given year. You're going to pay it on the year-end balance, December 31st, what's ever in there, even if it's zero. You could have $6 million in there on July 1st, but on December